Assalamualaikum and what's up? My given name is Muhammad Aiman Israel bin Khairul Anwar, and today we are going to talk about liabilities, the second pillar in accounting equation, which is asset equal to liability plus equity. Okay, now we explore the meaning of liability first. A liability is the financial debt of a company that result in the company's future sacrifice of economic benefit to other entities and business. A liability can be an alternative to equity as a source of a company financing. A liability also can help a company's organize successful business operation and accelerate a value creation. However, a poor management of liabilities may result in significant negative consequences, such as a decline in financial performance and worse, such as a bankruptcy. In addition, liabilities determine the company liquidity and a capital structure. To get a summary business liabilities, we take a look at the balance sheet. Balance sheet is basically snapshot of business asset, liabilities, and equity. In a liabilities section of the balance sheet, we list out the different liabilities. All liabilities must be arranged with the short-term liabilities at the top and the long-term liabilities further down. The other name for short-term liability is the current liabilities. Are defined a business debt that need to be settled within 1 year from now. The most common type of liabilities is an account payable. For example, the bill or invoice that we send when buying something for supplier by a credit. But there are some other examples for current liabilities, such as wages payable, interest payable, and the last one is a tax payable. After that, we continue about the non-current liabilities, which mean a long-term debt that are not expected to be settled within a year. There are many types of non-current liabilities, and I'm going to mention a few now. When a business want to raise money from outside to fund its operation or invest in a new asset, it's as a couple of options. For instance, long-term loan from bank who in return will expect to be repaid with interest. Furthermore, the business also can choose to issue bonds instead. The other type of non-current liabilities is a capital lease and deferred income tax, which is definitely for another day. Last but not least, the third liabilities is a contingent liabilities. The liabilities is a potential that may arise of uncertain future event. It's very special liabilities and too risky if you ignore that. For example, if you are buying an Apple product like iPhone, iPad, so the warranty of the product we call it as a contingent liabilities in case there are some future damage in estimated amount and should be recorded as a loss on the income statement and liabilities in balance sheet. As a result, liabilities are used by business to keep track of outstanding amount owed to a vendor, customer, and workers. It provides a shareholder with an indication of the company health as part of the balance sheet. In other words, liabilities are the key part of company's supplies and demand. Producer provide a product and the customer agrees to pay for them through a liabilities agreement. This is an open for money flow and continual cycle in economic growth.